The people who print money are quietly buying something else, not dollars. They're actually buying gold. And according to new data, nearly 89% of central bankers expect global gold reserves to continue growing over the next year. At the same time, 74% believe the dollar's share of global reserves will continue falling over the next 5 years. So think about that. The institutions responsible for managing the world's reserve currencies appear to be preparing for a future where gold plays a larger role than it does right now. And then something else caught my attention. The Bank for International Settlements, the central bank for central banks, is now warning that today's AI debt boom is beginning to resemble the credit structures that preceded the 2008 financial crisis. So what are they seeing that the rest of us are not? Micah Haynes from Noble Gold joins me now to break this all down. Welcome to the program. So I've been tracking this. Let's start with this big headline. Nearly 89% of central bankers expect global gold reserves to continue increasing, while almost three-quarters believe that the dollar's role in global reserves will decline over the next 5 years. Why is that such a remarkable signal right now?
Thanks, Gary, and thanks for having me on. And of course, I do think it's a remarkable signal because central banks aren't emotional investors. They're institutions that are responsible for preserving purchasing power and the wealth of nations. And typically, they think in decades, not in quarters, not in political cycles.
Right.
And when 90% of them say that they're going to continue buying gold while believing that the US dollar is going to become a smaller and smaller part of the global reserve picture, that's not a market opinion. That's a structural shift that's underway. And we know that that has been for the better part of the last 4 or 5 years. Gold obviously has no counterparty risk. It can't be printed. It can't be sanctioned. It can't be defaulted on. And so when countries are accumulating more gold, they're effectively reducing dependence on paper assets and on other countries. And I think that that's because they realize the world's becoming a multipolar place. And so to me, that's one of the strongest long-term signals that investors should be taking right now.
You know, I just caught a headline too here. This is from Reuters. The Venezuelan acting president has sent a letter to the King of England. It's like, I can't believe it's just a crazy thing. We're the king. We're sending a letter to the king, and but they're asking for all the Venezuelan gold held at the bank to be released to support recovery efforts. I want to just play this real quick, get
Among
your
others,
reaction.
to the King of England, asking for the gold being held at the Bank of England to be released. That gold belongs to our people, and it must be used to address the terrible, tragic consequences of this double earthquake. Venezuela has the resources to recover and to get back on its feet.
I mean, it's horrible what happened in Venezuela, and we pray for the victims there. But this is a really interesting move, especially after President Trump took out Maduro, and now they're writing letters to the King of England asking their gold back. What's your reaction to this?
Yeah, I'd say obviously a total crisis and disaster there, very unfortunate. But I think that it's actually in line and in theme with gold repatriation that's occurred over the last 10, 20 years. You've had Germany do the same, you've had France do the same. And I think the idea is that you want to have your gold reserves on your land at your fingertips. And so central banks have been doing this already, but with the case of Venezuela, you're right, it's interesting to see it on the heels of the removal of Maduro. Obviously, they're saying it in the context of needing to be using those resources to help them out of the recovery of the disaster. But I think obviously it's maybe just a catalyst in a bigger theme of them wanting it back anyway.
Yeah, it seems kind of odd. Like, okay, give us our gold so we can help with this recovery effort, but it's not like they're going to be like minting gold coins and then, buying material to, reconstruct their country. It seems like they're using the earthquake as an excuse to recall their gold from the Bank of England. And then, like you said, other banks are repatriating. Like this, we have from April, France officially removed all of its gold reserves from the Federal Reserve Bank in New York. So these are huge, huge moves right now.
Yeah, and it's interesting too to note, Gary, that it's kind of in the context of these audits at Fort Knox that Trump has been calling for. One of the big rumors is that the gold's not all there, or it's not all good delivery, or that it's been paper claimed multiple times over. And so this idea of everyone scrambling to get their gold back on, like I said, on their own soil, it just kind of again is in line and in theme with everyone buying more gold and projecting to be able to do that for the next several years as well. So I think obviously, he who owns the gold makes the rules. You want your own gold, like investors that we help. It's physical, it's yours. You don't want it papered over or anywhere else. You want to have it in your own possession.
Well, that's what Noble Gold specializes in. You can either have it in an IRA, or you can actually take possession of it. And I think that's where you guys really bring security to individuals. Central banks are buying it in record numbers right now. And it just stands to reason that the average person should be taking cues from these central banks. See, I want to ask you this next, because people often think of gold as an investment, but the central banks, they don't buy gold because they're trying to beat the market. So what purpose does gold actually serve inside of a national reserve, or somebody's own personal reserve?
Yeah, that's a great distinction, that it's maybe not an investment that you expect to make money on or to get rich on, Gary. Gold really isn't there to generate returns. It's there to provide protection and to provide confidence.
Well,
And
hang on. I do have to make one point very clear. I mean, you're not going to make a lot of money, perhaps, but if we look at the trend of where gold has been and where it is now, people who got in on the game, a year or two ago would be very happy
I'll
if they took action. So I just
I,
want to
I,
make that distinction.
and I'll agree with you there. I've been buying for 10 years. My first ounces of gold were $1,300.
Wow.
They've nearly tripled, or have tripled from even these levels. They were a lot higher, 5,600 earlier in the year. Anyone who bought from us a year ago has doubled their accounts. 2 and 3 and 4 years ago, they're looking at
Unbelievable.
doubles and triples. And so I say this, look, it is insurance first, but it's not that you can't make a ton of money by owning the right insurance at the right time. And during times of crisis, there's an insurance premium on these basic protective assets. But central banks hold these metals, or hold gold, because again, it's one of the fewest, or one of the few reserve assets that isn't someone else's liability. Treasury bonds depend on a government's promise to pay. Bank deposits require the financial system to be running properly. Foreign currencies, you're requiring that other country to have fiscal discipline. Gold depends on none of those things. And so, like I said, it's essentially monetary insurance. It's the asset that everyone needs to have to protect themselves and know that they'll never lose the wealth that they hold in physical gold and silver, but you don't own it primarily as a speculative get rich. I think we'll make a lot of money in this space over the next few years. But that's kind of the secondary benefit of just
Yeah,
having.
that's the icing on the cake, really, if you think about it, because that's why people convert their IRAs, because they want to have the stability. They don't want to have it stuck in a market. And then, of course, by taking possession of it, they hold it. It's not sitting in someone's vault, and they can actually look at it and hold it, and it's there. It's not going anywhere. And then, of course, when we see these market changes and we see gold rocket like we've seen, that's just secondary bonus. But so if you're managing, let's say, okay, if you're managing the reserves of an entire nation, what risks are you trying to protect against that ordinary investors may not be paying attention to?
Yeah, and central banks do think a lot differently and act a lot differently than individual investors. They're worried about sovereign debt levels, currency instability, geopolitical conflict, banking stress, inflation, maintaining levels of confidence in their own financial system, and they're constantly asking, what if something we've assumed is stable just all of a sudden is not? And of course, we've seen a lot of geopolitical tensions over the last several months, and most individuals focus on stock prices, returns, interest rates. Central banks focus more on managing systemic risk, and gold has obviously been historically the best way to manage that. And I think that individuals should think like the banks. I like to say, watch what they do, not what they say. We did have the government of China say recently they want their paper trading markets to be less manipulated. So they're putting a whole bunch of price regulations on that. They want people owning physical gold, but not speculating and investing so much in paper. We had the government of India recently ask their citizens to hold off on gold buying for the next year. And do you think, Gary, that that's because they're not buying it? So, watch what they
We
now.
want it for ourselves. We don't want you guys buying any gold because we want it for ourselves. I
Exactly.
mean, look at this headline. Central bank demand for gold is accelerating. World central banks acquired 41 tons of gold in May, following 20 tons in the prior month. That was posted just 55 minutes ago.
Yeah. Yeah, we've seen record gold buying from China, as an example, this last quarter. I think it was March that they posted like something like 4 or 5 times the largest monthly purchase that they had ever done previously. And so obviously the writing is on the wall. They're preparing for something. Individuals need to think of it as well. I'm a hunter, I'm a father, I'm a prepper, I'm a conspiracy theorist, I'm all these things. Gold and silver are part of the overall formula for protecting yourself and being a sovereign individual and protecting yourself financially. But it's all those other things that you need too. Food, water, guns, ammo, faith, community, gold and silver, just one small part of that. And so I would say, again, focus on what they're doing, not
Well,
on
look
what
at
they're
this.
saying.
Look over here. We have Poland, Uzbekistan, China, and looks like Kazakhstan, I think. Yeah. The top four central bank net purchases and sales. And China is continuing to add gold. Poland raising its long-term reserve targets again. Emerging economies seem to be leading this trend, like Uzbekistan and Kazakhstan. Is this simply diversification, or are we witnessing a larger shift in the global monetary system?
I think it's both. I think it's about diversifying or getting away from the dollar and all the risks there. We saw that Russia was sanctioned back in 2022 after invading Ukraine. And when you have $300 billion worth of US treasuries frozen and stolen from you, it doesn't inspire confidence. Now, if you're planning something or not that you think the US won't agree with, wouldn't you want to reduce your exposure and the liability that you have by owning US dollars? And so I think it's part of a bigger story that we're witnessing too. Again, it's a gradual rebalancing of the global monetary system. Gold always had a pivotal role in the financial system globally. And, like fashion, things come and go out of style. The entire world was on a gold standard prior to the 1929 Great Depression, Gary. Everybody came off of it during that time, except for the US, which later came off in 1971. But they came off in the 30s because they needed to be able to print money. Obviously, that's the problem we have now. We've been printing money and experimenting with quantitative easing and modern monetary theory really since 2008. We saw a ton of that out of
Yeah.
2020. And it's not just the US, it's the entire world is basically running a paper system house of cards with paper money, and fiat currencies are all going to fail at some point.
It's
And
a
these,
Ponzi scheme. We all know it. We've been screaming about the central banking system forever, and the Fed, back sound money. And when you can't end these institutions outright, the only thing you can do is copy what they're doing and protect yourself. Here, look at the zero hedge 5 hours ago. Polish central bank holds 632 tons of gold. Glapinski NBP has a PLN of 127.5 billion of unrealized profit. They're buying gold nonstop since 2016, and that's when he became president of the Central Bank of Poland. I mean, this is wild, right?
it is. It's unprecedented. And like I said, things come and go out of fashion. You have different cycles. The currency cycle is pretty standard. You start on a gold standard, you remove the backing of gold for something that's just a piece of paper, and eventually you pervert and overprint and abuse that piece of paper to the point that you'll experience high inflation or hyperinflation. And after that, you end up realizing that you need to return to a gold standard in order to reinstill confidence in the currency and its ability to perform its two main functions, which is to hold value and be used as a unit of transaction. And again, I can't tell you when, but we are going to see a return to a global gold standard at some point, and that's why these central banks are preparing in this way. It should be obvious to most people, but most people are just following advice from their financial advisors to hold stocks and hold bonds 70-30, 60-40, and we know that that portfolio is actually set for failure. 2022 was the first year where stocks and bonds together both plunged 20 to 30%. We do see issues with the stock market, obviously, and potential bubble warning signs there. We also see issues with the bond market as of late. So it was Morgan Stanley in the fall of 2025 that suggested maybe 60-20-20 is the new model, which is 60% stock, 20% bonds, and 20% gold. Gary, right now, all of the gold, all the mining companies, all of the things that are precious metals related in American portfolios represents about half of 1%. And what I expect before the end of the decade is we'll have a more traditional weighting, something between 3 and 5%. So from half of 1 to 3 to 5 is a 6 to 10-fold move of the amount of capital that Americans would need to hold in gold and silver assets or precious metals related assets. We're nowhere near that. But again, these guys are leading the charge. They act as smart money. They do things first. They
Well, look
go
what
where
China's done
it's
here.
moving. Exactly.
Look at Hong Kong launches a new central gold clearing and settlement system, strengthening the city's position as an international hub for the precious metals market. That's 11 hours ago. And then we have this retail investors dumping gold at a record pace because its 1-year return fell from 60 to 36%. Well, retail investors dump it. Then China says, I see an opportunity, and China imports 163 tons. It's like it's like the old thing, like hold it, hold it, hold it. Like you don't dump it just because it's falling. Like we saw it at 56, and now it's around 4 something.
4,100.
41, right? So
Accumulation opportunity. And,
yeah,
unfortunately, Wall Street refers to dumb money as people on the street and smart money as all this big institutional money, central banks and sovereign nations. And the smart money is buying like crazy, like it's going out of style, like there's going to be a gold shortage. And unfortunately, more emotional, retail investors have been selling. But, some people who own it, like I do, from $1,300, $1,500, $1,800, $2,000, they're still up and they're selling at a profit. But if you bought in January or December of last year when it was a little higher than where we are, you're selling at a loss. Now, we have these types of corrections within larger structural bull markets. It's completely standard. Gold and silver both can suffer 50% drawdowns within the context of a much larger precious metals bull market, like we had from 1971 to 1980, or from 2001 to 2011. So this is just part of the course, washing out the sentiment, washing out FOMO traders and momentum chasers. But we are a physical gold and silver company. This is not a trade. This is a long-term investment. And again, primarily it's insurance. And then you do get paid to own the right type of insurance during the right crisis period. So of course, we suggest to all of our clients, you're buying it to hold it. I recommend end of decade if you can. 2030 will have much higher gold and silver prices, and there are tons of analysts with different.
well, I could only imagine where it's going to be by 2030.
Both have doubled in the last year, and that's off the highs that they had.
Yeah. So I want to shift gears real quick because I know time is limited, and I want to talk real quick about the Bank for International Settlements. This is another concerning signal. They're warning that the debt funding from the AI boom is beginning to resemble the kind of credit structures we saw before 2008. Okay, that's kind of scary. So how seriously should people take that warning from the Bank of International Settlements?
Yeah, like you mentioned earlier, they are considered the central bank for central banks. They're not known for sensationalism, Gary.
Right.
When they issue warnings about credit markets, people need to listen loud and clear. History doesn't repeat exactly, but it does often rhyme. And so we've seen periods where excitement around a new technology kind of gets ahead of itself. A bunch of earnings get, kind of truncated into the very near future. It's not that the internet didn't change the world; it just didn't do that in 1999. And then the bubble popped by 85% in the year 2000. Housing did the same thing in 2006. And so AI, obviously that space for investors has been creating similar incentives, get rich quick. It's going to change the world today. We think it obviously will be changing the world dramatically, but the the course of implementation can take years, if not decades. We'll see how quickly it goes, but it's certainly transformative. It just, we don't know when we're going to be able to actually realize all that stuff. And so I believe that we're in a very, very similar time to 1999, 2000, before the dot-com bubble burst. And like I said, the NASDAQ dropped by 85%, and it didn't even get back to its 2000 high until 2013. You spent 12 years in the up so much more, or so big, and bubble is actually larger, and we're talking multiples larger by every metric available. So it's a very dangerous time. It doesn't mean that stocks are going to crash today.
Right.
I actually think that there's a big political incentive to keep the market any means until after midterms, but I don't think we're looking at probably something more than a year before we have a moment like an '08 or a 2000 or a 2020 or a 1929, kind of all mixed together.
So if central banks are increasing gold reserves while simultaneously warning about growing credit risk, what message should ordinary Americans take from those two developments that are happening together?
Yeah, I'd say don't panic. That shouldn't be the message, but it should be that they're preparing. And I think that, again, do what they do, not what they say. We need to be preparing ourselves. And I mentioned, as a father and a prepper and a hunter and a conservative, I've done all these things to ready myself and my family, from food stores to gold and silver and guns and ammo. We need to be thinking similarly, but I just want to speak on the financial side. It's worth paying attention to. Better to be 6 months early than a day late. I think that people need to look at their portfolio structures, what they're exposed to. Many people aren't aware, right? They're just set it and forget it. They trust their
Right.
financial advisor is looking after them. But truth be told, they're not looking at it either. They have you set in mutual funds and a 60-40 that they haven't done anything to change for the last 40 years. And like I said, Gary, that model worked up until 2022. It's a new world now. It's a new system that we're going into, and the old stuff won't protect you. What worked in the last 4 decades won't work for the next 2 decades, and you don't want to be investing in the rear view. Look at where the puck is going. That's where the central banks have been going. That's why they're buying gold like crazy. And silver, too, has become a strategic commodity across many nations at the sovereign level, including here in the U.S. The first time we've recategorized it as a critical industrial strategic commodity since the 70s. And so that shouldn't be taken lightly either. I don't want to make this all about gold. I'm actually a huge silver fan. But again, this is about protection, preparing, and being proactive, in my opinion.
Now, before we go, you've helped thousands of families over the last several years. When people call Noble Gold today, what are they most worried about?
I hear it all: the dollar, the debt, geopolitical issues, um, market volatility. I think all these things are relevant. I think they're also calling because they don't feel prepared, or intuitively they feel like they're missing something. Again, most people don't own any physical gold and silver, let alone have any exposure to the space at all. We're talking half of 1%, while 70% is in stock. That's the highest concentration ever. Meanwhile, it's one of the lowest concentrations in gold ever. So, it's about diversifying, it's about preparing, it's about looking where things are going and looking at what the trend is. And again, I don't encourage people to buy gold and silver speculatively. Yes, you'll make a lot of money in this space over the next few years. That just comes naturally with owning the best assets.
Right.
But you should look at it as, I need to review my total portfolio. Everyone has a different situation. Some people need income, some people need growth. You can get both of those things achieved through a proper portfolio rebalancing. And so we just take it one call at a time. I have helped thousands of clients, thousands of families, but every single person can have my personal attention, to be able to have their questions answered and the information that they need furnished so that they can make a calculated decision for themselves and their families, and to protect themselves for what's coming.
So, last question for someone who's watching this interview: what's the first conversation they should have before making any decisions about protecting their retirement or their savings?
I think it needs to be, what do I currently own? And what are the risks there? We mentioned the stock market's riskier than ever. The bond market is riskier than ever. I can't actually think, and I'm not trying to be, talking my own book here, Gary. I cannot think of another asset class that has a better risk reward structure than the precious metals. And I'm not pushing any amount of gold and silver on anyone in particular. I think that everybody needs some, but that amount is again, a case by case. So you need to figure out, what are your goals? What are you holding? what are the risks, and then how and what questions do you have that you need to have answered to be able to make that next step. And we're a super no pressure firm. We don't beat you up with calls. We're not interested in pushing product. We help people who realize that they do need some of this stuff, and we're here to walk you through that and let you know how to get that done.
All right, well, thank you for joining us today. And Patriots, look, today wasn't really about gold. It was about paying attention to what the world's largest financial institutions are actually doing. Because actions matter more than headlines. If central banks continue increasing gold reserves while expecting the dollar's share of global reserves to decline, that should at least make every investor stop and ask a simple question. What do they see coming? If you'd like to learn more about physical gold and silver and how they may fit into your long-term financial planning, visit nextnewsgold.com and request your free gold kit, because sometimes the biggest clues aren't found in what governments say, it's found in what they quietly do.